Numbers I want us to look at Forex risk exposure and IAS 21. Foreign exposure refers to the change in the value of the company due to the exchange rate changes. What is exposed? These are assets, liabilities, or income streams denominated in foreign currency. We want to look at accounting or transaction exposure, i.e. translating from functional currency to presentation currency. Functional currency or operational currency is the currency of the host country, i.e. where the project is located, whereas presentation currency is the one used at the headquarters, i.e. in the country of the parent. A subsidiary company reports both in local, i.e. host country currency, and in the presentation currency or the parent country currency. In the local currency, because of the stakeholders locally, banks, customers, employees, and the government. The MNC, on the other hand, must, at the end of the accounting period, consolidate sets of subsidiary accounts in the currency of the parent country, i.e. presentation currency, to report to the stakeholders at home. If the exchange rate has changed since the previous accounting period, there will be a restatement of assets, liabilities, revenues, expenses, gains, and losses. IAS 21 is the standard that we use, and deals with the effects of changes in foreign exchange rates. Its purpose is to set out how to account for transactions in foreign currencies and foreign operations. The standard shows how to translate financial statements from the functional presentation currency. One of the approaches is called monetary and non-monetary. Monetary items are revenue items, i.e. current assets and current liabilities. These are translated using the closing rate, i.e. the rate, exchange rate at the end of the accounting period. Non-monetary items are non-current assets and are measured in terms of historical cost, translated using exchange rate at the date of acquisition or transaction, but more practically at the opening date, i.e. rate, i.e. the rate as at the beginning of year. Inventory is translated at historical cost at historical rate, if reported at historical cost, but if reported at net realizable or fair value, it is translated using the current rate. Equity and reserves are treated as balancing item in the accounts, whereas incomes and expenses are translated using the average exchange rate, i.e. the average of opening rate and closing rate. Let's look at the format. And here you are. We have a balance sheet items and then the rate use. If it is current assets, e.g. cash, we use the current rate. Marketable securities, say treasury bills, we use current rate. And also receivables. Inventory, if reported at historical cost, we use historical rate. Prepayments, we use at historical rate. Non-current assets, say goodwill, we use goodwill. Land and buildings, machinery, we use historical cost. And for all liabilities, whether long term or short term, we use the current rate. want to get an illustration. And this is a certain company, Mwambu K Limited, is a Kenyan multinational corporation which owns a subsidiary in Uganda. And the exchange rates was as follows. On 30th June 2019, 31 shillings per Kenyan shillings. And on 30th June 2020, the exchange rate was Uganda shillings 32.5 per Kenya shilling. We are required to compute the translation gain or loss. Now, in the process of translating these figures, some gain or loss might be realized. Now, to draw up the balance sheet of the Ugandan subsidiary in Kenya shillings. So the balance sheet would look like, when you translate this is the balance sheet, these are the figures, and when translated, we might get a gain or loss. Translation gain or loss equals exposed assets minus exposed liabilities. Then the difference, you multiply by the difference between exchange rates, i.e. current rate and historical rate. We have 52 from the balance sheet, 52. See, one is cash, the other one is receivables, 55. Then minus 86, which 86 current liabilities, and then 120 long-term debt, bonds. Then we multiply, because these exposed assets and exposed liabilities are in Uganda shilling, we are multiplying with Kenya shillings. This is an indirect quote, 1 divided by 32 for the current rate, minus 1 divided by 31 for the historical rate. So that we don't have to multiply Uganda shillings with Uganda shillings, otherwise we will get square shillings. So when we do this, we get negative 99 times the difference in exchange rates, and we end up with 147,395 shillings, Kenya shillings. Then the balance sheet, we translate land and buildings using the historical rate, cost times a million, because these are in millions. Machinery, that was 4.32,258. Motor vehicles. Inventory is although it is a current asset, it is valued at historical cost, because it is reported at historical cost. Otherwise, it would have been the current rate. Then all liabilities at the current rate. Now, when you look at this, we get the total of current assets. Now, if we can subtract the values of accounts payable and bonds, we shall get the difference, which is 12.897767, i.e. we treat equity and reserves as a balancing item. Now, the translation gain or exposure, rather the translation gain or loss, is declared at the bottom of the balance sheet separately. Of course, it is embedded within the equity and reserves, but here you disclose it.